Two investments can have the same average return. They can have the same standard deviation. On a normal risk report, they can look like twins. Then the bad year arrives. One loses a little more than expected. The other falls through the floor. That is the problem James Xiong and Thomas Idzorek studied in 2011. They asked what happens when an asset allocation model stops pretending that returns are bell-shaped. Real returns are often skewed. That means the bad side and the good side are not mirror images. Real returns also have fat tails. That means extreme losses happen more often than a normal curve predicts. The old portfolio model saw average return, volatility, and correlation. That was useful, but it missed something investors feel in their bones. A surprise gain is not the same as a surprise loss. A good shock is pleasant. A deep loss can force selling, break a spending plan, or damage a pension fund. So the question is simple. If the normal curve is lying, what changes in the portfolio? Start with the old model. Mean-variance optimization is the language Harry Markowitz gave finance. Mean means average expected return. Variance means the average squared movement around that return. The model asks, for a target return, which portfolio has the lowest variance? That is clean. It is also polite. Variance treats upside and downside movement as the same kind of risk. If an asset jumps up, variance rises. If an asset crashes down, variance rises. The math counts both as distance from the average. Investors do not. After 2008, that difference became hard to ignore. Assets that had looked diversified in calm periods fell together. Return streams that looked smooth broke when liquidity disappeared. The real question was not just, how bumpy is the ride? It was, what happens in the worst 5% of the ride? Here is a small example. Imagine two bond funds. Fund 1 pays a modest yield. Most months are ordinary. Bad months are unpleasant, but not catastrophic. Fund 2 pays a higher yield. Most months also look ordinary. On a spreadsheet, the average return looks better. The monthly standard deviation may even look similar. But Fund 2 has a hidden pattern. It collects small gains for a long time. Then, in a funding stress, it has one very large loss. Mean and variance can blur that difference. They compress the whole distribution into two numbers. A left-tail measure refuses to compress the damage away. Xiong and Idzorek tested a different lens. It is called mean conditional value at risk. People shorten it to M-CVaR. The key piece is conditional value at risk, or CVaR. Value at risk, or VAR, marks a bad loss threshold. It says, roughly, here is the loss level you cross only in the worst slice of outcomes. CVaR goes further. It asks for the average loss after you have crossed that threshold. Think of VAR as the doorway into the bad room. CVaR asks what the room looks like once you're inside. This is why many risk managers prefer CVaR to VAR. VAR can tell you where the bad zone begins. It does not fully tell you whether the zone is shallow or deadly. If the tail past the threshold is thin, the average tail loss may be tolerable. If the tail past the threshold is fat, the average tail loss can be much worse. That matters because two portfolios can have the same doorway and very different rooms. One tail may slope down gently, the other may drop into a ravine. Now put that idea into an optimizer. Mean variance optimization asks for the lowest variance at a target return. M-CVaR asks for the lowest average tail loss at a target return. If returns are truly normal, the two methods agree. That is important. M-CVaR is not magic. When the world is bell-shaped, the old model and the new model point to the same frontier. The difference appears when returns are not normal. To study that difference, the authors needed a return model that could create realistic bad tails. They used a multivariate truncated levy-flight distribution. The name is heavy. The intuition is simple. They needed a simulator that could produce ordinary months, rare crash months, skewness, and fat tails. It also had to keep variance finite. The word truncated means the wildest possible outcomes are cut off. so the model can create ugly tails without becoming useless for portfolio work. This modeling choice matters for teaching. The paper is not merely saying markets crash sometimes. Everyone already knew that after 2008. The paper is asking a sharper question. If we build a return simulator that can control skewness and tail thickness, and then we feed those returns into a downside risk optimizer, do the optimal weights move? That is why the controlled scenarios are so helpful. They turn a messy market story into a clean experiment. The paper then runs 5 comparisons. The first 4 use a small made-up world with 4 assets. That lets the authors change one feature at a time. First, all assets are normal. Then one asset has a fatter tail. Then some assets have negative skewness. Then one asset has both negative skewness and a fat tail. The 5th comparison uses a real 14-asset class opportunity set. The historical window runs from February 1990 to May 2010. That is 244 monthly observations. The authors repeat the optimization 500 times with bootstrapped samples. They cap each asset at 30% long and 30% short. That keeps the optimizer from hiding the lesson inside one huge position. The cap also keeps the lesson close to real portfolio policy. Many institutions do not allow an optimizer to put 80% into one asset class. They use limits. They use committees. They use risk budgets. So the important result is not a fantasy maximum. It is the direction of the shift when tail risk is taken seriously. Now watch what happens. In the normal return scenario, MVO and M-CVaR produce the same allocation. No drama. When one asset has a fatter tail, M-CVaR cuts exposure to that asset. Mean variance optimization does not see the problem as clearly because the average return and variance can still look acceptable. When assets have negative skewness, M-CVaR again shifts away from the worse left tail asset. Negative skewness means the distribution leans toward large bad outcomes. Small gains may appear often. Big losses may appear rarely. But the rare loss can dominate the experience. Then comes the strongest case. The same asset has negative skewness and a fat tail. It loses badly on the left side, and that left side is thicker than the normal curve expects. Here, the allocation impact is largest. The plain English rule is this: the combination of negative skewness and a fat tail is the most dangerous shape for an optimizer that cares about severe losses. Picture the shape. A normal curve is balanced. The left side and right side are mirror images. A negatively skewed curve leans toward bad outcomes. The left tail stretches farther. A fat-tailed curve puts more probability in extreme outcomes. Now combine them. The left side is not only longer, it is heavier. That is the shape M-CVaR is built to punish. In the paper's controlled examples, the allocation to the problem asset moves by about 20 percentage points across scenarios when the authors change skewness and kurtosis. Kurtosis is the technical name for tail thickness. High kurtosis means more mass in the tails. For an investor, it often means more surprise in the bad states. The real asset test tells the same story in a messier world. Over the 1990 to 2010 window, the paper finds that global high-yield, U.S. REITs, U.S. TIPS, and value stocks had significant negative skewness. Non-U.S. government bonds had positive skewness. Global high-yield, U.S. REITs, and U.S. TIPS also had higher kurtosis than many other asset classes. So M-CVaR moved the portfolio. Relative to mean variance optimization, it allocated more to non-U.S. government bonds and U.S. nominal bonds. It allocated less to global high-yield, U.S. REITs, and commodities. Then the authors ran an out-of-sample test through the 2008 financial crisis. M-CVaR beat MVO by 0.8, 4 to 1.44 percentage points across the efficient frontier. That is not a promise that it will always win. It is a clue. The information inside skewness and fat tails had some predictive power during the crisis. This is also where the paper stays modest. The result is not throw away Markowitz. The result is Ask whether the Markowitz inputs are too narrow for the job. If the main risk is ordinary volatility, mean variance may be a good map. If the main risk is tail loss, the map needs another layer. Let us put the symbol ledger on the board. Mean is average expected return. Variance is average squared movement around the mean. Skewness tells us whether the distribution leans toward big gains or big losses. Kurtosis tells us how fat the tails are. VAR is the loss threshold. CVAR is the average loss beyond that threshold. M-CVaR is the optimizer that balances expected return against CVAR. Here is the human translation. Volatility asks how wide the whole distribution is. Skewness asks whether the danger leans left. Kurtosis asks whether the tails are thick. CVAR asks what happens once the bad tail is already happening. That last question is the one a crisis forces you to answer. But there is a catch. Tail modeling is hard. A 2012 comment by Stephen Greiner made a sharp point. Xiong and Idzorek showed that M-CVaR can beat MVO, but it was not always obvious whether the gain came from skewness, kurtosis, or tail correlation. Tail correlation means assets become more correlated in bad markets than they are in normal markets. That may be the cruelest part of diversification. The umbrella works in light rain. Then the storm arrives, and every umbrella turns inside out at once. The authors responded that tail correlation is important, but so are fat tail specification and other non-normal return features. That answer is sensible. It also leaves the practical lesson intact. Do not treat one number as the whole story. A tail-aware optimizer can be more honest than mean variance optimization. It can still be wrong if the tail model is wrong. There is a second catch. The optimizer may become sensitive to assumptions that are hard to estimate. Expected returns are already hard. Tail shape is harder. Tail correlation is harder still. In a calm sample, the worst observations may not include the next crisis. In a crisis sample, the worst observations may overstate the next decade's normal state. That is why tail-aware allocation should be treated as a stress lens, not an oracle. There is also a sample size problem. The real asset study used 244 months of data. The worst 5% tail contains only about 12 observations in each sample. That is enough to teach the mechanism. It is not enough to make tail estimation easy. So how should an investor use this paper? First, use it as a diagnostic. Ask which holdings have negative skewness, fat tails, and crisis correlation. Those are the assets that may look better in calm volatility than they feel in a crash. This diagnostic can be simple. You do not need a perfect levy flight model to start. List the assets whose good years come from selling insurance, lending to weak borrowers, using leverage, or harvesting carry. Then ask what their left tail looks like. If the answer is vague, slow down. The risk report may be hiding the main risk. Second, use it as a comparison tool. Run the old mean variance portfolio next to a tail-aware portfolio. Do not blindly choose the second one. Study the differences. The assets that shrink are where the old model may be underpricing tail damage. The assets that grow deserve questions too. Are they truly safer in the tail? Or did the sample make them look safe because the bad regime has not arrived yet? This is the discipline the paper encourages. Use the optimizer to ask better questions. Do not use it to stop asking questions. Third, use it as a warning about smooth income. High-yield, leveraged real assets and carry trades can look attractive for years. They can collect small gains. Then one bad state gives back years of comfort. M-CVaR asks whether the yield is paying enough for that rare bad state. That lesson applies beyond institutions. A household portfolio can have the same problem. A dividend fund can look steady until rates jump. A real estate fund can look smooth until liquidity closes. A high-yield fund can look diversified until credit spreads gap wider. The left tail is not an academic decoration. It is where the investor discovers what they really owned. That is the trade. The Markowitz framework remains useful, but the normal curve can be too polite for real markets. Risk is not just how much a portfolio wiggles. Risk is also the shape of the left tail. Xiong and Idzorek showed that negative skewness and fat tails can move the optimal allocation because severe losses change the meaning of diversification. Before you trust an efficient frontier, draw the worst 5%. Before you trust a sharp ratio, draw the left tail.